Hi, good afternoon, and you're all very welcome to our webinar today on pensions for business owners. My name is Tara Clemens. I'm the current chair of ACCA Ireland Committee, and I'm delighted to be chairing this discussion this afternoon with this very distinguished panel. We have Ross McCarthy, Rafe Benson, Kristen Foran, and Michael Houghton. So if I go to you, Ross, if you would like to introduce yourself.
Hello, thanks for inviting me today to Fergal and to Ralph. My name is Ross McCarthy. I'm the chairman of ISME, and I suppose part of the reason why we were asked in was to, highlight the importance of pension provision. And there's a couple of key aspects to this, really from an employer perspective. Providing access to pensions with auto enrolment on the horizon has never been a more important point. And it's something that many businesses simply haven't done yet. There's still an absence of provision for vast swathes of the private sector, and that's something that mandatorily is going to have to change. And then secondly, many simply don't think enough about their own pension provision. And I suppose there are three kinds of businesses. There are people that sell time, there are people that buy franchises, and there are people that try to build equity. In the first two of those kinds of business models, the onus is really to put into a pension, but too many aren't. The reason being that you're not building necessarily a strong equity value within the business. It's not effectively how those kind of business models work. In the third one, sometimes there can be complacency, where people think that their business is going to have a disposable value when they sell it. And in the fast moving world that we find ourselves in these days, long-term equity value building doesn't necessarily work. So pensions can never be underestimated as an area, and it is something that in Ireland we're behind several markets, but be that Germany, New Zealand, Australia. We're several decades behind them in terms of this kind of conversation. And it's high time that the focus that Pensions Awareness Week is bringing to this topic really becomes more mainstream.
Thank you very much, Ross. And Kristen, what would your main message today be?
So my role is National Sales Director in Zurich Life, and what we are seeing are huge changes, I suppose, in pensions in the last few years. Some people are taking a bigger interest in pensions, and many are not. As Ross said there, we're behind many other markets. And the key here is really, people understanding pensions better, because there's definitely an issue here with, I suppose, complications or perceived complications of pensions, that people don't understand them very well. And it's something we want to get across well, so this gives us a great opportunity to do that. Pensions remain the most tax efficient way, the tax efficient way of saving in Ireland as it stands at the moment. And there's huge opportunity here for wealth extraction for business owners. So really, that's my key today, is really to talk about that and how you can actually take wealth extraction from a business in a hugely tax efficient way.
Thank you. And Michael, if you'd like to introduce yourself.
Yes. So my name is Michael Houghton. I'm definitely a pension believer, would probably be the best way to say it. And I know Ross, you mentioned the different types of business owners out there. I'm definitely one that sells my time for money. So pension has been a great way for me to utilize and be tax efficient and get money out of the company into my own name, so to speak. I'm also part of the FIRE community, which stands for Financial Independence Retire Early. I have a podcast called the Irish FIRE Podcast, and I'm about 6 years away from being fully financially independent. So a pension is a tool which is allowing me to actually do that.
Thank you. Interesting. We'll be coming back to that one later, Michael, for lots of your tips on how to do that. And finally, yourself, Rafe.
Yeah, hi Tara. Rafe Benson is my name. I'm one of the founders of moneycube.ie. We help businesses and individuals maximize their money through pensions and investments. And I guess, absolutely agree with Kristen's message that, as an industry, there's a lot the financial services industry can be doing to improve the experience of business owners and to support them in extracting their wealth and protecting the wealth in their business, but also, helping them support their team, with employee financial well-being as well. So I guess the big message I'd like to get across today is that, businesses need to see pensions and financial advice as one more supplier to their business and demand those same standards around transparency, around efficiency, around economic returns and value, and trust, and manage that just as they would any other supplier in their business.
Thank you. So in terms of the topics then, I guess, that we'll be covering, I'll be coming to each one of you to ask you around these, will be around why pensions are important for our small business owners, because Ross, I'm sure you have all the stats close to hand around the amount of small business owners that make up the backbone of our economy. What does a retirement plan look like for people in 2020 and beyond? And what kind of pensions are out there, both for business owners and for the people that work for them? And then I suppose the most important thing and the key takeaway we'll all be doing this afternoon then will be, what action should I be doing to secure my financial future through a pension? So we've received a lot of your questions in the recent days, and here's just a sample of those questions that we'll be tackling today. We've used some actors' voices to voice the questions that you've sent in by text and by email, so here's just a sample of them.
I'd love to start a pension, and I know I should, but I just can't afford it right now. Is there any point if I only have a small amount to put into a pension?
I'm really focused on my business at the moment. My business is my pension, and I'm starting to make some real money. I don't want to get hammered with 52% tax. So what are the options? Can you help me figure out how best to invest my money in my pension from my business?
I'm self-employed and run a small business with a few employees. I'm looking to start a pension for myself and to maximise what's available to me from a tax efficiency perspective. I also want to figure out a way to pass my wealth on to my kids. Any idea where I'd start with this?
Hi folks, Alan Reynolds here, Brian Reynolds Car Sales. I'm 44 now, so I'm reasonably late in getting to look at my pension. Is there any particular pension that would suit me at my age? It's been suggested that I also put the pension through the company, and I was just wondering, would that be more beneficial? And is there any downside to that? For example, if the company got into trouble at any time in the future? Okay, thank you.
I hear all these ads about starting a pension and they say speak to your financial advisor. Do they mean an accountant or mortgage broker? How do you find and choose a financial advisor?
So Ross, we'll come to you first. Business owners have thousands of things on their minds this year more than ever. So where do you see a pension fitting in with all of this?
So really where a pension fits into the scheme is ultimately it allows business owners to hedge their prospects. Too many business owners look upon, particularly those business owners that are building brand equity, or that means that their business has an intrinsic value that they may be able to sell on to somebody else at a high multiple, as opposed to selling time or having a franchise where, again, it's more of a cash-driven model. The biggest risk, as we would see it, would tend to be in that latter part, where people think that their wealth is tied up in their business, and when they sell it, they'll extract the value. But that doesn't work in an era now where 25 years into the internet in Ireland, there are entire business models that are disappearing with each year that goes past. And one of the things that COVID has shown in particular this year is just how many business models that were linked to day-to-day staples of lifestyle have simply been, whether that's theatre, dramatic arts, performing arts, cinema. A lot of these businesses were 6, 7, 8 months ago were seen as fundamentally sound, long-term, cash-driven businesses, and they're incapable of withstanding the shock that they've been through. So one of the lessons that business owners should take out of this is that you never know when you're going to be automated away or simply become irrelevant. And if you're not providing for your future as part of the way that you run your business, it's like taking the blood out of your veins. You're not going to last long. And you're effectively not providing a nest egg. And I suppose the last point I'd make is, just as that's true for the business owner, It's incredibly important with auto-enrolment on the horizon that good quality options are being placed on the table that allow employees to manage their risk. And owners need to lead from the front. If you're not doing it for yourself, how can you expect other people to provide for their future?
And that leads us very nicely on then, Kristen. You obviously, through your role in Zurich, would handle pensions for lots of Irish businesses. So can you walk us through then in practice how that wealth extraction through a pension actually works?
Yeah, well, I mean, just as I said earlier on, I think it's about trying to keep it as simple so as not to complicate it too much for people. The way I see it is, you've set up a business, hopefully you are profitable, you're doing well. And just as Ross said there, many people tend to leave money there and that build up the value of the business. And I think it's a bit of an outdated notion. The way I see it is you have three options when it comes to the profits that you're making in your business. One is to indeed leave it there. You pay corporate tax at 12.5% whenever you extract it. You could be paying a surcharge of 20% if you have a closed company. And you could also be paying capital gains tax of 33% on the sale of your shares. The second option I see is to withdraw money from your business, so take it out as a salary. You pay high income tax, you pay USC, you pay PRSI. In effect, you could pay up to 52% of it out as a tax return. Your third option then is to actually put money from your profits straight into a company pension, so as an employer contribution into a pension. The employer gets tax relief of corporate tax rate of 12.5%, and the employee doesn't pay any income tax, and have any income tax or PRSI or USC charge on it whatsoever. That money is going into a fund. That fund will build up tax-free. You'll probably add to that fund again in the future. And what you'll end up then is a very, I suppose, a tax-efficient vehicle that will build up a huge fund for you, potentially for when you actually retire. So you're extracting your money from your business in a very tax-efficient way. And you also can do it at quite large limits. When you look at putting money into an executive pension or an employer-based pension, we can do a funding quote which tells us how much money you can actually put in, and those limits can be quite high. So what you could find is you could be building up a pot of maybe €2 million, taking that money efficiently from your business and not paying tax on that money, which otherwise you would have paid quite a lot of tax on. You still come out at the end of the day with still, I suppose, an efficient business there, but you also have this pension fund, a fund that can't be touched if anything goes wrong with your business in the meantime. So it is providing you for your future. And again, it goes back to this idea of, your financial independence, retiring early. If you're making those plans, this will give you the means to actually follow those through. So it's a hugely tax efficient way of actually getting to a point of your business working for you officially.
Thanks, Christian. Michael, you mentioned earlier that you hope to be financially independent in a number of years. So you obviously run a small business and you've been doing this aggressive funding. So can you talk us through that experience when you started and how's it all gone? What lessons have you learned that you can share?
Yeah, to be honest, I've learned so many lessons I probably couldn't cover it in the webinar we have now, but look, to summarize it briefly, I basically got my business to a point where it started making extra money. And I then had the option, similar to what Ross was mentioning earlier, that I had the option to either take it as salary or to keep it in the company or to actually move it to a pension. And when I looked at all of the options, it was a clear no-brainer that the pension movement was the best one to take. And very much now I've put the business in such a state that I always pay those pensions first. I'm more keen to make those contributions than I am my own salary in many cases, in terms of just having that kind of mission. And I think the automation is fantastic as well in terms of, you can automate the process into your pension so that you don't even see it as, or you don't even have to physically make the payment. It just becomes what feels like a normal expense every month. So yeah, it's a huge part of our family's long-term wealth plan. As I mentioned, our business is solely tied to time. So, it was very much that feeling every year of, right, I need to get up and go again and keep working. And look, what happens if I can't work for whatever reason, or, I'm in the IT industry, so technology changes so quickly. What happens if the technology that I'm using suddenly becomes outdated and I can no longer find projects for that technology? So it's very much about putting long-term plans together. My own background, being from New Zealand, we don't have anything near a 50% top tax rate. We're more around the top 30% top tax rate. So when it came to looking at that and trying to work out a way to actually plan tax efficiently, then it was really a no-brainer in terms of utilizing a pension.
Thanks, Mike. And Rafe, obviously MoneyCube is an advisory business, so how are SME owners' attitudes changing towards their pensions? And have you noticed any change, particularly in the last 6 months as a response to COVID-19?
Yeah, certainly, Tara. I mean, I guess generally there's a move in the Irish market where I think SME owners are more demanding when it comes to their pensions. They're asking more questions about it, and they're expecting more. And there's just a general move, I suppose, towards taking control of your pension as a big part of your wealth, and recognition that it needs to be kind of actively done if you're going to separate that wealth out from your business and create a long-term pot. So how do we see that? We see in practice, business owners coming to us asking to run the numbers on how they can really extract value. I think that might be if you have a good year of trading, as Kristen's mentioned. Revenue recognizes that if you work for yourself, there will be good years, bad years, and your cash flow might be lumpy, and it takes account of that in how it gives you tax relief for pension contributions. But it also might be what Michael's just talked about there. I mean, it's just a great example of a business owner who has, if you like, laid out a long-term roadmap to build his wealth in a strategic way through a pension, so having a plan to take that value out over time. And I suppose the other thing is a bit of humility from the advisory and pensions community. We're here to we're mere custodians of other people's money, if you like, and there's definitely a sense now that people are willing to shop for advice. A pension that looked like a good deal 10 years ago for a business might be very different to what looks like a good deal now. Your business might have different requirements, and this industry has probably had benefited from the stickiness of pension assets when it comes to long-term plans. But smart businesses are looking at how they can either trim their cost base, improve their employee benefits by actively managing their pension for themselves and for their team. I guess in terms of COVID-19 and adjustments that people have made there, one of the things is it's probably prompted people to look at their money more closely, right? Yes, trimming their cost base and making sure there's no fat in your business, but also actually in terms of actively managing the wealth and understanding where they're invested, how that looks. Very different situation if you're retiring in 18 months to if you've got another 20 years before you hang up your boots. So it's that kind of thing that we've been working through with business owners over the last 6 months.
Okay, thanks very much. Now, one of the ways that we can do that is through the small self-administered schemes. So this is a type of pension which business owners themselves can set up. They can choose their own investments and generally exercise quite a bit of control. So we have a short video here now from my fellow accountant Angus Burns, partner in Grant Thornton. And it's a good summary of SSAPs as you're going to get in 90 seconds.
Hi, my name's Angus Burns. I'm a partner in Grant Thornton. I also head up Grant Thornton Pensioner Trustees Limited, where we set up and administer small self-administered pensions for our clients. They tend to be corporate managers, professionals, SME owners who like to be more hands-on in building their personal wealth. Direct investing in businesses and residential and commercial property with the ability of the pension to borrow remains very popular, and using a tax-exempt structure has many benefits. Not only does the company making the pension contribution receive a corporation tax deduction, there's no benefit in kind on the individual, so full saving of POI, PRSI and USC. Within the pension trust, all income and gains are fully exempt up to retirement date, when monies can be drawn down by way of tax-free lump sum or taxable withdrawals. Deferring tax on income and gains over a period of time allows for significant growth. And the pension trust is not only an efficient structure to build personal wealth, but is also useful in segregating cash from trading companies as part of a strategy of risk management, succession planning or preparation for sale of business. Pension structures are one of the few remaining tax reliefs available to personal investors and are significant tools in building up personal wealth.
Perhaps you could expand a bit on Angus's video there, Rafe. Who are SSAPs suitable for, and what kind of person tends to use them?
Yeah, great question. Like, I suppose, self-administered is the key bit there, right? It's a pension where you exercise a very high degree of control over what is in your pension pot, right? Now, typically in Ireland, they've been used for property-related pensions, right? So typically, somebody is assembling a pot of money in their pension. They can raise mortgage debt against a property, and very often when we look at these schemes, there's some property in there which is throwing off cash, maybe some fresh contributions in, and you stand back and you go, there's an investment which is all connected to property on a little small island on the edge of Europe, plus some cash. And the new development in recent weeks there is that on the whole, most of these pensions will be being charged negative interest for the cash they hold there. So one of the strong messages we would say to people who do that is think about how you use your cash, your balance of assets within your pension. Is it all property and cash? Should you be putting that cash to work? Are you overextended in property? Those kinds of things. I guess the second point we'd make is that small self-administered pension schemes are not for everyone. Typically, if you run your own business, life's pretty busy, and you do find pensions where they have a perfect portfolio for where the owner was 10 years ago and haven't really moved on since. So it can be a great solution. It can definitely help people take charge of it. But it's you would need to be engaged with your money and have strong views on how it's invested. And for the vast majority of people, I think there are much more kind of user-friendly, quick solutions out there that aren't going to take up your time and are going to give you a highly diversified, efficient portfolio very quickly.
Okay, thank you for that, Rafe. And Ross, what would be your views on SSAPs from the viewpoint of your ISME membership?
I suppose I back to the financial fluency question. For people that have a high degree of financial fluency, they can be a modular and relatively easy to assemble pension scheme. So while they may take some time to build, even just at a basic level, if you wanted to work towards getting to a situation where you had income annuities in the 60 to 80,000 euro range, and you're able to invest into an SSAP, particularly where you get windfalls, you may be able to build up a property portfolio. In Ireland, it's about as classic as they come, where you might have 3 or 4 400,000 euro values throwing off 20 odd grand a year in rents each. And that's more or less how you get to an annuity in or around that range, and that would be one classic flavour. The second one is, and this is where I think it's important that people do get good financial advice, is that people can default towards that model where there may be something that is that's available through whether it's Zurich or one of the other pension providers, by actually talking to and engaging with people, because you can end up over-invested in a single property class or property category. For instance, there will be a good chance that some people within ISME would have overexposure to commercial property. And if you take that as an example, with working from home and other impacts that are potentially going to arise from COVID, what you think is a safe bet today, if you're not properly diversified, can actually have negativities for the person who thinks they have a strong and a positive pension investment strategy.
Thank you for that, Ross.
Choice is good.
Thank you, Ross. Michael, you were mentioning earlier about setting up a self-invested pension for your own pension needs. So what's your thought process on this? Can you talk us through that?
Yeah, I mean, it's definitely something that I'll be doing in the long run. At this stage, it's not something I need to consider because the pension contributions I've made to date don't really justify the cost of running the self-administered pension. But the great thing is, Ross hit it again, he talked about choice. We're always going to have that option. So again, I'll be talking to my financial advisor as the years go on, and eventually we can make a switch. So eventually we can move from some of the current pension plans that we're in and move over to a self-administered pension. And whether that be property, there's a good chance that there'll be some property in there, or just being able to buy some of those ETFs or various investments. That's really what I'd like to get done from it.
Yeah, very good. Thanks, Michael. And Rafe, as you were mentioning there, the self-invested pension isn't for everyone. It's not a one-size-fits-all. So the majority of business owners are going to use a major pension company along the lines of Zurich. So, Christian, can you talk us through the typical company pension setup then?
Yeah, pension schemes are very popular, and we've seen a huge increase actually in them, particularly last year and coming into earlier this year. They're a great benefit to provide to employees, and typically what happens is the employer decides how much they're going to contribute, be it a percentage of salary for each employee, and they ask them to match that. And that can be as little as 2 or 3% of your salary, or I've seen it go up to 15, 20% of your salary. So it really depends on the resources of the company. And so basically what happens is we set up a pension pot for each individual within the company, and we have this wrapped up in a pension scheme. The money comes in by the employer, so your contribution as an employee comes through your salary to your payslip, so tax relief is deducted at source. And it's a really efficient way of paying into a pension. So your employer's contribution goes in, your contribution goes in, and you get your own tax relief then. So to put that kind of in a straightforward, easy way of looking at it, I suppose if your employer puts €100 in and you put €100 in and you're on the high tax rate, that you're basically saving 40% tax. So it's costing you €60 for a €200 contribution going in. So it's really, really important to understand the amount that can actually go in. It's usually done on a monthly basis, so your employer sends in the contributions monthly. You'll be with a provider, say like Zurich or one of the other providers in the marketplace. You'll get access probably to the website. You'll be able to keep tabs on how your pension is doing. And the great thing about pensions, particularly pensions paid on a regular basis, is that they benefit from the idea of compounding. So more and more is going in over time, and you see the value going up, particularly if you're invested well and you get good returns from it. There's also other benefits attached to a pension scheme. Very often employers will look at providing benefits like death in service. So this is an amount payable should an employee die, so it's payable to their next of kin, to their estate. And benefits like permanent health insurance if an employee can't work for a particular length of time. So there's a range of benefits that can be applied as well with a pension scheme. And this has become really important in the last couple of years as employers are trying to, I suppose, retain talent and make sure they have the best packages available. And again, these are cost-efficient ways of providing benefits that would be, I suppose, really prohibitive perhaps on an individual basis in some cases, but as a collective group within a pension scheme, they can be quite a I suppose, a cost-effective way to provide these benefits. So employers are very keen to actually look at them, and they've been set up in that way now for a long time. There are other ways of providing benefits. You have PRSA groups have been set up in the last few years, although employer pension schemes themselves remain probably the most popular way of providing benefits.
And you mentioned there around the tax relief for the employee, but from the employer's point of view, there's considerable tax relief too. Can you talk us through that?
Yeah, they're getting tax relief themselves on the contributions that go in, and they also don't have to pay PRSI on it either. So the employer is benefiting from an employee, going into the pension scheme, as is the employee. So everyone is benefiting from this being in place. So again, it's a case of why wouldn't you do it?
Mm-hmm. But there's limits on it, and I know there's a lifetime cap on what you can put in, and this is something ISME are looking at, Ross. Do you want to talk to us about that?
Yeah, well, I suppose there's a couple of quick here. The first is there's a fundamental mismatch in terms of the treatment of income as income, whether you earn your income in the public sector or the private sector. So the actual way in which the value of the end salary that's taken within the public sector, it's done of 20 times your average last 3 years of salary, whereas there's a cap in place for private sector workers, and there's a substantial of public sector workers who would end up with a pension pot well in excess of 2 million in value, and there's nothing to them. And this includes at the very top of the civil service, who are on very substantial salaries, and they're currently or these thresholds. So ISME is currently supporting the pulling together of a challenge, which is going to go in and test the constitutionality of that. So we're looking at a couple of different avenues to do that, but our fundamental hope would be that we'll be able to, worst case scenario, move the threshold back to where it was before the last financial crisis, which was at about 3 million. And I think that will provide more help for a lot of people that are looking to manage their pension schemes and provide for the future. But this is fundamentally a question around equity and the equal treatment between people, regardless as to where they earn their money.
Yeah, thank you.
I guess, Tara, there's the thing is that pensions have changed a lot in the last 10, 15 years. If you roll back, say, to, one's parents' generation, typically either your company gave you a defined benefit when you retired, which was a percentage of your salary, and you didn't really have to worry about whether that was going to come or not, or how much it would be, or you weren't worried about the market performance and these kinds of things. Now, that's kind of a thing of the past. Defined benefit pensions are like hen's teeth, and the vast majority of people not in the public sector are dependent on the vagaries of the markets, both for building their pension wealth, which can be good and gives you all the control and things we talked about just now. But it also means that when it comes to retirement time, if you're looking for anything close to a guaranteed income, you need a colossal pot of money, which would begin to deliver you that, because bond rates are low and annuity rates are low. So as Ross says, there's a mismatch here between guaranteed income in retirement for some people, and what's effectively a very aggressive tax regime for others who are in comparable senior roles but in the public sector. So I think it's not a question of putting public against private here. It's a question of how can we actually treat people in the same way, and give those benefits, and actually be consistent in terms of government messaging. Everything we do as part of Pensions Awareness Week is about helping people realise quite how much government wants to incentivise us to start and maintain pensions. So it's kind of it clashes with that message to find then that the cap has been brought down several times, and really kind of I suppose prevents the people in who senior roles building up that pension wealth to anything that's comparable in the public sector.
Yeah, thank you. Michael, do you want to jump in there?
Yeah, I mean, I guess, look, the way that I see it, and sometimes the word pension particularly, I mean, I'm only 36 years of age, so for me to think about pensions at my age sometimes seems a little bit strange, and sometimes I get, people look at me strangely when I even mention that I'm so focused on the pension, but I don't even look at the word pension. I look at it more as a personal investment fund. And, Ralph kind of hit it on the head there when he talks about the fact that we need a lot of money to be put into these things to actually be able to withdraw enough to live off long term. And I think, with the power of cost averaging, meaning that we buy into it every month, and it doesn't matter if the market's up or down, we just keep buying in there and buying as many units of a fund as possible. In fact, I'm of the belief that a market crash is the best thing for anybody who's in their 30s or 40s now, because it will allow us to actually get more units cheaply. But very much just trying to see that as your own personal fund that's going to be there for your future when you actually need it. And look, any of these things, it's very difficult when you hear that you need, €1 million plus in terms of how much money, but you need to make a start at some point. And, seeing it as even a small start. I started my pension at €500 a month. I'm now putting around 2,500, 3,000 euros a month in there. So it's one of these things that you can start, and then you can gradually increase over time as you get more comfortable and used to the money going out. And when you no longer see it as an expense, and you see it actually as an asset that's growing for you and something that's going to be there for your future, then it makes the whole process a lot easier.
No, I was just going to say that 100% of, and while Ralph is absolutely right, within the public sector, 100% of people have defined benefit pensions. It's 8% a private sector. So that's really the size of the issue when we're talking about trying to achieve equity between all forms of income. Sorry, Kristen, I'll get back to you.
No, that was okay.
Okay, so Ross, you had mentioned there earlier on around auto-enrolment. What's happening on that, and what do businesses need to do or need to know on it?
It's very interesting, actually, because, this year has pretty much gone by in the blink of an eye. So we're pretty much at the stage where it's 15 months until it's from 2022 onwards that this is going to have to be provided for. Now, these things, people can play with timelines and all the rest, but very much in ISME, we're very supportive of this coming in as soon as possible. We have absolutely massive unfunded liabilities in Ireland. Going back to the public for a second, they're paid for from current tax. They're not funded. It's not like Germany or New Zealand where you have a personal savings account, regardless as to where you work, and you save into it from day one, very much the way that Michael is doing. In Ireland, the public pension, including the statutory pension, is entirely unfunded. So, all of us need to ask ourselves, is there really going to be a state pension for us in 20 years' time or 25 years' time? Or is it more prudent to assume nothing there and adopt the attitude, right, that I'm going to have to be able to get enough for me to get a livable income, some form of a state contribution to that. We're moving from a situation where we had 5 people working for every 2 people retired to a situation where within the next generation, it'll be closer to 2 to 5, 2 people working for every 5 people retired. So that's what we're looking at, and that's why auto-enrolment is particularly important, and employers need to be prepared to make sure that they've good schemes.
Thanks for that, Ross. So we've heard quite a lot of information there from our various contributors. So now we've done all the talking. The focus now for Pensions Awareness Week is our action. So we're going to ask you, as our audience, to make a commitment regarding your pension today. We're going to finish a little bit early so that you can make that promise right here, right now. So that might be to start a pension today, or to plan seriously about extracting wealth from your business over the time, or to overhaul your company's pension, or to engage your team in their financial future. So coming up on the screen, there should be a link, and you can email then the promise that you're making. So Pensions Awareness Week has brought together a huge range of businesses who can offer to help you deliver on your promise. We're here to help, but the next move is going to be up to you. So there's a button now on your screen if you want to take that action right now. I'd like to thank all of the panellists today, Ross McCarthy from ISME, Christian Foran from Zurich, Michael Houghton from Fire Podcast, and Rafe Benson from moneycube.ie. Thank you all, and thank you for participating today.
Good afternoon, everybody, and welcome to the very first live webinar of Pensions Awareness Week. So it is Monday, the 21st of September, and I am Liz Dwyer, and I am a journalist and a business owner, and probably a very unlikely host for Pensions Awareness Week. Last year we were launching a show called Future Beauty, and I was quoted in the Sunday Indo as having spent more money on my face than my pension, which sounded exceptionally vain, but it was pretty true because I've actually never even put €1 into my pension fund. So I'm in my 40s, and I'm like 900 other thousand people in Ireland who have not yet started their pension funds, and it's something we all need to start addressing and changing the conversation around. So I'm here today with 2 experts. We have Rafe Benson, founder of MoneyCubed, and Stephen Rice, who is the lead of pensions in Aviva, and we're going to talk through some of the basics about getting started, why pensions are such a no-go topic for so many of us, and how to get really rich before we all retire. So gentlemen, what are the number 1 facts you would like to get across to our audience today? Stephen, I'll start with yourself.
Hi Liz, and look, I suppose just to kind of start with from my perspective, it's great to be involved in something like this. I suppose I'm quite passionate about pensions, about making sure people are saving and have an adequate pension at retirement. Yeah, but just it has been for many a year. I suppose, look, the 3 key takeaways for me today are, I suppose, that pensions don't need to be complex, particularly where you have a good advisor involved. they can actually be quite simple and be very easily demystified. I suppose the second is that they are very flexible, around the level of contributions that you make and the kind of investment choice, you control that element of it. And I suppose, look, the third and the biggest one is, for everybody, is that you don't need to start by making really big contributions. Most pension schemes allow you to start with smaller contributions and to build those contributions as you move through your working life. So they'd probably be the three big ones for me.
Okay, thank you, Stephen. And Rafe, what about yourself?
Yeah, hi Liz. I guess the big message we have today is that the hardest thing with the pension is making a start on it. So I guess if you're watching this, you've already taken that first step, and don't make the best the enemy of the good here. Your pension doesn't have to be perfect; it just needs to be working for you over time.
Okay, fair enough. Okay, so I guess what we really want to do is kind of start, like, as you guys said, you wanted to demystify the idea of pensions. And I suppose from my perspective, and I'm sure I'm not alone in this, I kind of view pensions as something for men in grey suits who work in these big corporate conglomerations, or who have HR departments and accountancy departments behind them, and it's all this brilliant way to like shove money into this lovely fund for when you're retiring. But what about for the rest of us, people like me who are self-employed, or people who dip in and out of jobs throughout their career, self-employed patches? And I guess especially at the moment with COVID and everything, our work paths are very up and down at the moment. So I mean, it's something we all need to address. We're all going to be living a lot longer, we hope, and hopefully we all will be, in other countries, it's seen as a very normal thing to start doing in your 30s, and in Ireland we kind of need to start changing that conversation. So we've had loads of questions coming in over the last couple of days, and here's a little sample of what we're going to be talking about over the next hour.
This pension stuff is so confusing. Can you explain a pension to me like I was a 10-year-old, please?
Hi there. My name is Emer, and I'd love to ask a question, a pensions question, please. I was wondering if you could explain sort of in basic terms what exactly the difference between a defined contribution scheme and a defined benefit scheme, and which should I consider one over the other, or are they only applicable to certain people, or just a brief explanation would be great. Thank you very much.
Hi everyone. So my question is, to ensure a pension, if I stop working and just become a landlady, what kind of tax can I pay? How much is it? And how often do I need to pay it? Thank you.
Hi, I have a question about how I get my private pension from work that I left a good few years ago when I started having children. Where do I locate it?
I'm like too old to start a pension. I'm thinking to start a pension, but am I too young?
So obviously we all know the key purpose of a pension is to pay yourself effectively when you are in retirement. We all are entitled to the state pension, but for many of us we don't realise how little that really is in terms of compared to our current salary and our current standard of living. So what exactly does it look like going forward for the average person?
Yeah, so look, I think, Liz, obviously it's a real positive, that people are living longer, and indeed not are they just living longer, but are they staying healthier and more active as they live longer. And I think, look, what this slide really highlights is the fact that at an emphasized level, we've seen a significant increase in age profiles, or the number of people who are reaching 100 even since 2005. So this isn't going back 40, 50, 60 years, that even since 2005, in the last kind of 15 years, there's been a threefold increase in the number of people reaching age 100. And what that means is effectively they're going to have to pay themselves for longer. If we take it back to a more practical level and pragmatic level, the average life expectancies now are somewhere around age 82. So, give or take, it's slightly lower for men and slightly higher for women. But that's the kind of age profiles that people can expect to live to. Yeah, they're the Irish stats as they stand at the moment. And I think it's important to note that for younger people who are starting to save now, those age profiles are expected to increase into the kind of mid 80s if you look at any of these that are out there. So what that really means is that even if you're retiring at 65, 66, 67, you can now assume that you're going to have to pay yourself an income in retirement for somewhere between 15 and 20 years. That is really the critical thing. And I suppose the important factor of that is, the type of retirement that you can enjoy will depend on how much you actually put away now to support yourself in those later years when you do retire.
Okay, fair enough. Rafe, have you anything to add to that?
No, I think that's absolutely right. So it's about thinking of how much time you'll have to enjoy this money, and that's why it's so vital to take action now to put that money down, get it working for you over time, and take charge of it so that it's building up for you.
Okay, and just talk me through the state pension. What are we all entitled to normally, and when does that begin? Either of you.
So look, again, I suppose I'm happy to jump in here, Rafe, if that's okay.
Yeah.
Sounds good.
So recognise that the state pension does form the very good foundation for people's post-retirement income, but that's all it's ever going to be designed to do. It is designed just very much to be the foundation, if you like, to pay the basics, or maybe some of your groceries, your bills. I mean, if you look at it now, it's at 248 euros a week. So again, just to put that in perspective, or I suppose in context, that would typically cover kind of maybe bills and, as I say, food for people. But I think really what this slide is trying to highlight here, and what people should be cognizant of, is how much or what percentage of your final salary does the state pension actually cover. Again, as you move up through the salary scales, obviously as a percentage number, that number drops. And it's really, could you afford to live off that number if your final salary was kind of increased? And I think the important thing to note here as well, particularly, if you're focusing on younger people, it's that it's not your salary that you're earning now. Most younger people would expect that as they move through their working life, their salary would increase. So I think it's important to do a sense check against this on a regular basis, really just to see, actually, God, now based on my salary now, what percentage, or how would that look if I was to solely rely on the state pension, and to kind of look then at how you can supplement that and using private pension provision to enhance that.
Okay.
Again,
so in terms of, it's about €1,000 a month. That's kind of the average if we were to kind of average it out now. And could you survive on that? And I mean, could you survive well on it is the answer, really. I'm sure most people could, but it's the kind of what caliber of life you would like to have in your retirement, and what level of comfort you're hoping to achieve. And also, I suppose a lot of people in their late 60s or mid 60s onwards, it's not going to be just you anymore. A lot of people have extremely extended families that they're looking after. Grandparents look after the children and the grandchildren. It's not just me on my own, like as a silo anymore. Would you guys agree?
That's absolutely right, Liz. Yeah, I'd agree with that. You can see that across Irish society, right? We've moved from sort of needing houses that will house 3 generations of people to a housing stock that will require 4. So, for all of us, our timeline is getting longer. That might mean we've got more years to save up and invest, but it also means we're going to need a big old pot there for us when the time comes to start drawing it down. Yeah.
Okay. So we're going to do a little poll here about the number one reason that is stopping all of us, or not, most people I'm sure who are tuned in here today, from getting started on this kind of pension highway as such. For me, it's just this overwhelming topic that I kind of just starting to get my head around. So I mean, the 4 main things we're wondering is it, number one, is it you feel like retirement age is just so far away that it's not worth considering right now. Number 2 is the idea of starting a pension far too complicated and just a bit overwhelming. I think I'd definitely be in that bracket. And number 3, you reckon you can't afford it. I'd probably be in that bracket too. I'm wondering, could I put €5 in a week and still be still be doing well? And we'll be taking this poll now in a second. And number 4 is that you might have other investments or, perhaps property or something in the pipeline that you think you'll be relying on instead. Okay. Before we go on to that poll, I just want to talk about how taking charge of your money is, really important. And we have a video here from Matt, who has attended one of the Money Cubed events before, and he is going to tell us why he found taking charge really helpful.
It was complexity. It was the enemy is the best of the good. Haven't thought about it, should do it, haven't done it, worried about it, and therefore just not done it. Just pushed it under the carpet and avoided it. For me, I'm right at the start of my investment journey. I haven't invested anything in my life other than a savings account. So coming to an event like this with Maximise, MoneyCube, I know I'd feel relieved. It'd be like a weight off my shoulder to have done it. So I need to find easy ways to do it, easy ways for me to put the money that I'm earning into somewhere safe that's going to give me a return. And that's what I need to do for me.
So that was helpful, Matt. We should all be a bit more like Matt, I think. So back to our poll. So if you would like to partake, all the answers are coming along the screen below. So we've number 1, I can't get involved with the whole pension idea because I feel like retirement is too far away. B, it's too complicated. C, I can't afford it. Or D, I have other irons in the fire that's going to keep me going throughout my retirement. So if you'd like to take a little vote down below, and we'll come back to the answers later on. Okay, so Stephen and Rafe, I'd just like to come back to you. Okay, so let's talk about the practicalities of getting started. I mean, again, this is where things start getting confusing and a bit like I start kind of zoning out here. So can you explain this in really simple English? Like what pensions are out there and like how am I going to start? Like I don't have a pension, I need to start clearly, and I'm a bit scared. So, you know, hold my hand here.
Yeah, I guess, you know, Liz, the way to think about it as a starting point is like a pension is a piggy bank that you can't smash until you're 60 or thereabouts, you know. So you're putting money in and it is your money. That's something that is kind of a lot of the pensions industry has maybe forgotten over time, but it's you know, it's your money, it's got your name on the tin, and it is invested in assets that have scope to grow over the long term. So, and is there for you when you retire. That's kind of the foundation of it, right? It is a savings account which you can't smash for a few years. Now, I guess delving into that a little bit more, there are pensions which come through your work from a company, but also, like you said, you know, if you work for yourself, or your company doesn't offer a pension to you, then you kind of got to roll up your sleeves and sort that out for yourself, you know. So that's probably the fundamental two kinds, is a company pension or a pension that you've set up yourself and are paying into. So I guess that's maybe a bit of a starting point to get your head around it.
Okay, so how do I get one? Like simply, what do I need to do? Is it a form I fill out online? Do I need to go into a bank as such? What do I need to do? Or do I need to show someone I've got a big pile of money?
Yeah, so most people, like, if you're setting up a pension yourself, you definitely can fill in a form online through a business such as MoneyCube. But really, what you're looking to end up with is a situation where you've got an account open, which is getting the tax benefits of a pension, and which you're paying into each month. Probably going to be a direct debit from your bank, and potentially putting in lump sums each year, you know. So yes, we're in the business of giving pensions advice. We stand back, look at your overall situation from both an affordability perspective, what's practical to put in, no point paying in money you don't have, but also, you know, what does it all look like? Is this going to be worthwhile for you? And is it invested in a way that works for you? That might mean you want to access tech stocks, or you want to invest in property, which is something we'll be talking about on Wednesday as part of Pensions Awareness Week, or maybe you want to be invested in ethical funds. So there's a conversation to be had about that as well. So
you can actually choose where your money has been invested.
Yeah,
have a say in it.
You know, when we think about it, that shouldn't be news, right? It is your money. That's just something that the pensions industry needs to be reminded of. So yeah, that's absolutely right.
I just assumed that these men went off and bought loads of stocks somewhere and hope for the best. No. And I say men, but you know what I mean. The pension industry, that they just went off and bought all these bonds and stocks and shares, and also that I could come back and they'd be like, "Sorry, we lost all your money," you know. Because that's what happened to my parents, and I'm sure a lot of people in the last recession. It seemed like all of their pensions were squandered. So like that would kind of frighten me a lot. Is that still the case?
Well, I guess that's back to the message, right? So you know, pensions can be great, but you do need to do them right. Okay, so it's not without risk, but then doing nothing is not without risk either, right? So it's all about controlling that. So now, fact is, if you invested in a fund which holds 3,000 other companies in it, you'd be extremely unlucky. And in fact, you've probably got a whole load of other problems you're more worried about if that didn't deliver you a pretty material return over a 25, 30-year period. So it's all about putting your eggs in lots of baskets. It probably is unwise to bet the farm on a single asset for your pension, but there are now easy ways where you can, as you say, be in the driving seat there, choose those investments, get advice along the way. And it's kind of like any other long journey. You wouldn't set out to walk to Sydney without checking your progress along the way, and if you were heading in the right direction, and if you needed to make some changes. So it's not something that gets solved, once and you never look at. It's a journey that you'd check in on maybe once a year along the way to see how you were doing.
Okay, so it's kind of like a mortgage. I mean, as in like you might check in on your mortgage and say, oh, should I be changing my interest rates? Should I be changing to a different provider? Should I be adding more, less kind of thing? So you can tweak it as you go.
Yeah, that's right. And the pensions industry has moved on in Ireland in the last 8-10 years, and what represented a good deal then isn't necessarily a good deal now, So I would definitely say this is something, just as there's a lot of conversation out there about switching your mortgage and updating that along the way. We really encourage people to, dust down those bits of paper you received, or log in online, get the latest, and just see if you're getting value, if it's right for you, and you'll find there's almost certainly something you can do to improve your pension position.
Okay, and I suppose the big question is how much do you need to, what's the bare minimum you can put in, and what's the maximum you can put in per month, let's say? Or is that how long is a piece of string question?
It kind of is. So depending on your circumstances, it can be very generous in terms of getting tax relief. And I think Stephen's going to talk about that in a moment or two, to put large sums into your pension. But to give you a kind of rough sense, right? At a minimum level, there are plenty of people out there putting 75, €100 a month into pension. After tax relief, that might be costing them 45, €60 per month. So it's much better to start small, do something and build, than to wait for that big payday when you're really going to do it. So that's so far better to start affordably, see some of the benefit come through, build up your wealth, and then really get after it. So that's maybe the first answer. But for self-employed people, for example, if there's anyone out there sitting a bit worried, maybe kind of in their 50s, wondering that they should have done more, the tax system recognizes that people who work for themselves need to be able to catch up quickly with their pensions, and you can find that there's often a lot of benefit to putting in quite substantial, even six-figure sums into a pension in a tax-efficient way. So, everyone's situation is different. That's where we add some of the value that we add, and there's a lot of money to be won and lost by setting this up correctly.
Won and lost. There you go. Now, Stephen, tell me about this tax relief. It seems to me like you either give all your money to the government or you give it all to your pension. And the really rich, clever people give it all to their pension. I want in on this. What do I need to do?
Look, I think, again, as you touched on there, it's very rare that the government give you something for nothing. And to give it across three kind of strands is a real benefit. And I think it shows a commitment, to be fair, from kind of government on government, or government after government, should I say, and that they recognise the importance of people having a pot of money to kind of pay themselves in retirement. But, really the three main types of tax relief are, the first one, I suppose, is on the contributions that you make into a pension. And if you take it that pensions are effectively longer term savings, nowhere else for every €100 you save, if you're a higher rate taxpayer, will the government give you 40 euros back, or 40 cents in the euro. So to put it in simple terms, for every €100 if you're a higher rate taxpayer, you will get 40% tax relief up to certain limits on that. So it makes it attractive to kind of pay into it.
So break that down for me. So let's say I'm earning 50 grand. What does that mean?
Well, basically, so if you're say at your age there, at just early into your 40s,
what are you talking about? I'm only 21. obviously.
Yeah. But just using that as an example, we're in your 40s,
Yes.
in your early 40s,
Yeah.
you will be able to put up to 25% of your pension into into a pension and claim tax relief on it. So that it's a
Okay.
staggered, as Rafe was saying there, the older you get, the more attractive the government have made it for you to save higher amounts of your salary into a pension because they recognise the need to play a bit of catch up. So that's kind of broadly, that's the first thing is that, again, chatting to your advisor, the likes of Rafe and the guys at MoneyCube, they'll be able to advise based on your age how much theoretically you can put into your pension out of your salary. And it is staggered to favour those who are a little bit closer to retirement from a percentage perspective.
Okay.
The
Do you need
second
to be
thing,
in? Oh yeah, go on. Keep going.
no, so go on, yeah.
I was just
No,
going
you're
to say, do
okay.
you need to
We're
be in
great.
consistent employment? Like a lot of people would take career breaks, or they might be in and out of work, whether it's by choice or just situational, especially at the moment. Like, is that something to consider? Like, I always thought it had to be someone in a very stable, consistent job.
No, I mean, I think the big thing for me is, as I said before, that you've pretty much in a lot of circumstances, you've control over the contributions that you make into a pension. So, if you went through a period of time, for example, where you might have been self-employed and then you
Yeah.
went to work for an employer, as Rafe already alluded to, there's different types of pensions that are available to you. But the critical thing is that, you don't have to be in a consistent employment, or you don't have to be consistently self-employed. Or likewise, if you did go through a period of unemployment or a period where, maybe if affordability was an issue or a problem, at any point in time, you can absolutely stop making payments. You can increase payments, and in a lot of all situations, you can play a bit of catch up, and you can kind of make additional contributions to make up for lost time.
Okay, cool. So I mean, I suppose ultimately the message. Yes, go on.
So no, I was just going to say the other thing from a tax relief perspective, which I think is quite important, and I know you've alluded to in the poll there as well, is the other two big tax reliefs are on investment growth. So again, we've talked a little bit about the having control over where you put your money, but again, the government don't tax you on any investment growth that you make within your investments. So if your fund is growing by 4% per annum, that means you get the full 4%. And the third thing, again, for those who are coming up to retirement, and it's why I believe that you're never too late to start a pension, is that everybody is entitled to a certain amount of their pension funds tax-free when they retire. And again, just depending on the types of pension you have, how long you've been saving, and the type of employment you've been in, tax-free, that everybody is entitled to a tax-free payment at retirement out of their pension fund.
Okay. So, I mean, the key message, I think, is just to stop being scared and to try and start taking a little bit of control back of this whole money situation. And I mean, I suppose banking everything has moved on, the way we bank, the way we save, the way we do everything. It's just also, we control it by our apps, it's not the way it used to be at all. And I'm guessing even from today, it seems pensions have evolved and come along with the whole money system nowadays.
Yeah, I guess from my perspective on that, Liz, there's evidence out there that someone entering the workforce today will have 14 jobs on average through their career. So, the world of work looks very different than it did for maybe your parents, where, went in, would have had maybe one or two jobs, pension came with it, it was guaranteed, it was based off of your salary, you never had to worry about it, it just kicked in the day you got your clock and your golf membership. That does not exist anymore. So there's good and bad in that. Obviously the bad bit is you have to deal with it yourself, but the good bit is you're in control. There's a lot you can do about it. It's you who pulls the levers now, and it's much more about kind of putting the user in the driving seat here.
Okay, well that's good to hear. Okay, so we're going to chat through our poll results which have come in. Thank you very much. Okay, so, oh God, this is completely opposite to what I would have expected. So only 4% of people said they would not start because retiring is ages away. I thought that would have been the number one. 56% said it's too complicated. Do you hear that, lads? 56%. We need to take this down and make it even more simple. 26% said they can't afford it. So as the gentlemen were saying, you could even, starting with €75 a month. So if you're like myself, I would think I can't afford it. But then if I actually, if I'm realistic, I'm spending like €200 a month on my hair. So I probably should, maybe rethink that. And then the 13% are using other savings investments to retire. Again, actually, it has been proven that pensions are still the number one best bang for your buck, effectively, regardless of what you're inheriting or investing in. Pensions are still number one. Gentlemen, have you any comments about those poll results?
Well, I guess for me, the one that jumps out there is that it's too complicated, right?
Yeah.
So let's maybe take that one head on.
Yeah.
And hopefully, everything we're doing through Pensions Awareness Week begins to break that down for people. I guess what I'd say is pensions can be complicated.
Yes.
I remember talking to one of Stephen's colleagues at Aviva, and he's their like pension technical consultant. So that's you need to be feeling well for that. But he said like a job like mine shouldn't exist.
Yeah.
There are countries out there where that is the case. But we do have a very complicated pension system, and as I say, you can by navigating that, you can save yourself a lot of tax along the way. However, at its simplest level, if we go back to that piggy bank, it doesn't have to be complicated. So you can make it complicated. You can choose your own investments. You can squeeze every last tax dollar out. You can structure your business in different ways. But you can also sign up for a direct debit, which is going into a broad basket of index funds from Vanguard or State Street or BlackRock or anybody else, and is giving you a little tiny piece of hundreds and thousands of companies out there that are growing and investing every day for you, and just drip feed that money in every month in a tax efficient way and let it grow without any tax on the growth over 10, 20, 30 years, So they're kind of as complicated as you want them to be, but certainly we get a lot of customers who say, make it easy, make it simple, and that's our job to do.
So can I just ring you and you just sort this out for me? I'm still a bit confused.
Yeah, well, I guess I'm having a pretty busy week right now with Pensions Awareness Week. But
I don't mean today.
But I guess that that's probably the first step.
Well, I'll just ring Stephen then if you're not interested in my money.
Yeah, but maybe Stephen, I think you had some thoughts on that "not right now" point, which it sounds like it's not coming across very, very as too much of a worry for people. But there is evidence, isn't there, that the earlier you start, the more money, if you like, the less money you have to put in each month to come up with the same amount of cash.
Yeah, absolutely. I think, look, just go back to the poll and go back to the thing about tax relief first from my own perspective. I think you're absolutely right, Rev. I think the complexity thing, you can be as involved as you want, or you can take as what I would call as much of a hands-off approach and let other people kind of manage the money. But obviously, do check in on a regular basis, and particularly as you move through your working life, to make sure that you're invested in the right type of funds for you. Is it the right asset mix, etc. But again, that's where the likes of MoneyCube and advisors play such a pivotal role. The age thing, I suppose, is really important for me because, although it might come out as a poll that it's not necessarily the biggest restrictor that I feel I'm too young, it is probably something that people should be aware of, and just in simple terms, if you're looking to say, well, at retirement, I want a pot of €200,000 for argument's sake, is what I'm targeting as a pot of money. If you start at age 50, the amount of money that you'll need to put in versus the amount of money that if you start at age 40 is almost double. So if you take it in practical terms, if you want a pot of money of 200,000 at age 65, and you give yourself 15 years to save for retirement, you broadly speaking need to be putting somewhere around €1,100 a month in to a pension before tax relief. If you reduce that to age 40 and you start saving at age 40, you'd probably be somewhere around €650 a month. And again, that's just without tax relief and not factoring in investment growth. But it's just to give you a very simple example that the earlier you start, it significantly reduces the amount that you will need to put away each month to make sure that you're kind of on track to get to that target that you want to get at retirement.
Okay, what's the average age Irish people start their pensions at? Do you know?
I'll maybe jump in there, but the evidence that we have is that the people really get to grips with this. Like most of us go on a financial journey, right? So it's typically when you're in your 20s, you're just getting some salary in, you're starting to be financially independent. You might then start building a deposit for a house. You in your early and mid 30s, maybe small children, the dreaded second mortgage, also known as childcare. So it's really kind of when you're in your late 30s, early 40s, that's when people start to get serious about this stuff. The mortgages kind of got into a regular pattern. Maybe the schools will stay open and you won't have expensive childcare bills. Maybe they won't. You can really start to put in some significant money. But, as Stephen says, it just, the benefit, your future self will thank you the more you do today, right? So it's the old, the old story of asking directions, and the chap says, well, I wouldn't start from here, but, that would be great if we'd all ploughed money into our pensions 10 years ago or whenever, but life's not like that. The point is, you start where you are today, and you start chipping away at it as you can.
Okay. I guess,
and I think maybe
Stephen,
just to add one small point to that, sorry, Liz, it's just idea around building up the habit of making payments, and the simplicity of them coming out usually by direct debit or potentially from a salary deduction, depending if it's employer sponsored. But it's just this idea of building up habit, as I'm sure we all know, that once you get into the habit of kind of doing it and putting a little bit away, it's much easier then to look to kind of increase it incrementally over time, rather than have this daunting thing of having that look and feel of, oh God, I have to put a bigger sum away to begin with to get up and running on it. Because if you start chipping away much earlier, it's a habit, and all of a sudden, before you know it, you've built up a small but decent pot earlier in your working life.
Okay, but if you haven't, don't worry. It's never really too late to start, right? That's the message. Unless you're maybe 66.
Well, absolutely. Look. For me, again, I go back to that point that I made a little while ago about getting tax-free lump sum at retirement. So even if you are a little bit later into your working life before you start, there's two key benefits really to that. One is that, the money you're putting in, you're getting tax relief on. So that's obviously a real benefit. And from affordability perspective, particularly if you're a little bit closer. But secondly is, you can get that money out tax-free. So there is an efficiency there at retirement, versus maybe just putting it into a bank or a credit union, for example, at the moment, which are paying kind of zero or negative rates even.
How much
and will
money
be for
can you
the
get
next
out
while.
tax-free? Stephen, how much money can you get out tax-free?
So look, it depends on each individual circumstances. It's capped at a maximum lifetime limit per person of 200,000, but usually it will be 25% of the fund or a multiple of your salary, depending on the type of pension that you have. But again, using that example of 200,000 as a pot, if you're self-employed and you're a pot of 200,000, that means typically you could expect to take 50,000 tax-free. So again, it's not a small amount of money by any means.
Okay, fair enough. Okay, so I think we are going to go into some rapid fire questions now. We've some of our viewers and our subscribers have some video questions they would like to present to Stephen and Ralph right now. So I think we're going to see some of them.
Hi, I have an ABC and I'm a little bamboozled by the management charges. My company charges more than other companies for their annual management charge, but their performance is quite good, so I'm unsure whether to stick with them or to move to another cheaper company. I'm 44 and working in the public sector.
I'm doing well at work and I'm able to save some money. Could you tell me how much should I invest in my pension each month?
I was having coffee with a friend the other day and she was telling me all about her pension. I suddenly realised that I haven't been focused on starting a pension, and I want to know, is it too late to start, or should I even bother?
Can you tell me what exactly happens to my money when I put it in a pension? Where does it go? If I need it, can I access it, and if not, when can I get a hold of it?
Hello, my name is Michael and I'd like you to explain clearly to me what is a PRSA. Thank you.
Hey guys, I've heard of people's pensions falling in value. I just want to know, how do I prevent that from happening to me?
So, Stephen and Ralph, I guess I've just a couple of quick fire questions that I'm getting in here. I will start with you, Stephen, if that's okay. Should I ask my employer to switch me to a defined contribution scheme?
Well, look, I suppose to begin with, you need to kind of understand what type of pension that you are invested in. You know, broadly speaking, if you're asking to be switched to a defined contribution scheme, it may mean that you're in a defined benefit scheme. Very simply, defined benefit have been designed to give you a specific pension based on your final salary when you retire. Defined contribution schemes tend to, it's the value of the fund that you've accrued or saved over your time, plus the investment growth is what you'll have to buy your pension or buy your income in retirement. Most defined benefit schemes, as I say, because they have defined pensions at retirement, are deemed to be kind of the golden pensions, if you like. So I wouldn't, without talking to an advisor, be looking at switching out a defined benefit scheme into a defined contribution scheme, because in most instances you may be better off staying. But again, it just depends on a lot of different circumstances. So do talk to an advisor before making a decision.
Okay, I suppose a really pertinent question. Rafe, you might take this one. Can I cash in my pension?
Yeah, it's a good question, and obviously with the year we've had, it's one we've had in several times. You know, clearly when people have put money in a pension, it's probably the biggest single pot of money they own, and you know, pretty valuable to them. But I guess the flip side of the tax benefits we've talked about is the deal with the government, which is that you know, we will give you tax benefits for putting this money in, provided you use it for paying yourself an income in retirement. You know, so what does that mean? In practice, it's pretty difficult to get your hands on a pension before you hit 50. You know, officially, most pensions can be got from sometime in your 60s. With a bit of work and pulling some levers, it's often possible to access pension money from the age of 50. I guess the point I'd make is that doesn't make it the right thing to do. You know, when you spend it today, you deprive your future self of that investment growth, and you also, you know, the sooner you tap into that pension, you are going to have to spread it over more years. You know, so you're kind of making your life more difficult in the future. But you know, as I say, 50 is probably the key age for most of us, unless we're you know, champion golf players or some kind of you know, sports people who typically do get access early. So yeah, that's 60 in general, 50 with a bit of work, but tread with care.
Okay. Stephen, this is a good one. Can a lump sum from an inheritance be invested in a pension?
Yeah, so I suppose it's always tricky when people look at this, and particularly people, you know, if they're coming, I suppose, that little bit closer to retirement, and they're deemed to be able to see that they can get a little bit more tax relief, based on their age profile. In short, no.
No.
He's gone awful quiet there, hasn't he?
Yes. Okay. Right. Well.
Shall I say a few words on that?
Stephen. Yeah, you can. I guess you can jump in.
What I'd say, Liz, is, you know, a euro doesn't know whether it's an inheritance euro or an employment euro. So, you know, what a lot of people might do is, if they receive a lump sum, is decide to put more of their salary into their pension and use some of the money they've got as a lump sum to live off. So, you know, these are all the kinds of things that, you know, with a bit of creative thinking and work, that's where the money is won and lost. But, you know, with clearly, you know, the tax relief, you can't get tax relief on tax you wouldn't have otherwise paid. So so that's probably why I think Stephen is maybe just focusing in on, you know, could you literally put an inheritance money into a pension? But as I say, probably if you do receive a lump sum, that's a key question to be asking yourself: is now a good time to be topping up my pension with some other money? You know. I was really taken with the poll result, Liz, on it's such a dominant response, isn't it, that this stuff is too complicated. So I just wonder if it's worth spending a moment or two really just talking about the exact steps we take as a business to help people start their pension, because it might just kind of, we always, there's all this time of year especially, there'll be kind of ads on the buses and stuff, and it's all, pensions are great, talk to your advisor, and most of us are like, I'm probably between advisors right now. I don't retain an advisor for weekly heart to hearts. So but in terms of what we do as a business, we have a series of questions we would answer to understand someone's situation. It's not an interrogation. It's like a one pager of questions really around what's your age, what's your salary, what's your current pension position, and quite quickly we you have a fairly good steer on where people sit and what the big opportunities are for implementing some improvement. Then we're a regulated business. We're regulated by the central bank to provide financial advice. So we would provide a formal pension recommendation. It's like a 5-6 page document, so pretty detailed. Has all a kind of the actual recommendation in terms of which pension provider we would recommend. So it could be an Aviva or any number of other businesses that we use. So we've kind of 5 investment providers and around 4,000 funds at our fingertips. So a lot of flexibility within that. But so we would make a recommendation in terms of where it's invested, how much it's invested, for how long, whether it's a monthly or a lump sum or both, what the costs are. So one of our big values is around transparency and straight talking. So we disclose as much as we disclose everything we can in terms of who you're paying what to, so that you're clear in your own mind. And then typically, we might have a call or a video call, or in the olden days, face-to-face meeting to kick it around, chat about it, and make sure everyone's clear on how it all fits together, and maybe make some changes. But assuming somebody says yes and is willing to go ahead, you're looking at a kind of a couple of days to get a form signed on DocuSign, get a direct debit set up, and have the money going in a into that tax wrapped piggy bank.
Okay, so actually what's interesting is you're saying it's all online now as well, which is kind of, you don't even have to leave your bedroom at this point to get this all set up, which is quite good given the circumstances that we're in right now. Okay, well, that was nice and simplified. Thank you. Can I just go back to my quick fire questions, because they're coming in fast and thick here. This is a very interesting one. During my retirement period, if I'm settled in a different country, how can I access the Irish funds at that point in time? Stephen, do you know the answer to this?
So again, look, what I would say is that, if you've already retired, it's chat to your advisor, see what's the best way in terms of getting your pension paid into different bank accounts, etc. But again, what I would always say is each circumstance is different countries have different regulations, etc. Depends on whether you've drawn them down or not. So do chat to an advisor who'll be able to walk you through your specific case.
Okay. A lot of kind of similar ideas here. People were saying about if you open a pension and pay in a lump sum by October the 31st, 2020, you can claim back income tax paid in 2019. Can you explain this, please? Rafe, do you want to explain that?
Yeah, so like a lot of people won't have full visibility on their earnings each year, right? So the tax return system and the income tax system gives you until October of the next year to kind of true all that up and finalize it. Okay. So, over the next few weeks and months, that's what we'll be helping a lot of people to do. So it's look back, what was your income level in 2019? How much from that income could you actually put into a pension in terms of tax relief and also in affordability, how much is in the bank, and then how much did you already pay in, because you're going to have to take that away to get to what's left on the table. But a lot of people who don't have either visibility on their earnings or who maybe have a lump sum at this stage would pop that into their pension in a oneer. And clearly that boosts the value of your pension right away, and you get a piece of paper from a business like Stevens, which Revenue recognise as your evidence that you have contributed to a bona fide pension, and you can either put that into your tax return, which is due normally by the 31st of October, or indeed you can just let Revenue know online by uploading that PDF document to myaccount.ie or to ros.ie, depending on which one you use. So, pretty simple process. It's just about letting them know. And what's good about this year is actually just last week, Revenue have extended that deadline. So for online letting Revenue know, it's going to be in early December. You could be able to top up lump sum and so just to put some number, you might, if you've got, lump sum, I'll pick an easy number of 10k lying around, then, you would be sending that across on an electronic fund transfer to a pension. And that would reduce your 2019 tax bill by €4,000 if you're a top rate taxpayer, or €2,000 if you're standard rate 20% taxpayer.
Okay, and our last question. It's a bit of a sticky subject here. There is a lot of talk of pension fund crises. What is the story here? Who wants to take this? Stephen, you're smiling. Go on, you can take it.
I'm happy to take this. Look, I think the critical thing for me is in its most simplistic is, it's people looking based on their age now at what type of funds they should be invested in. And again, that's where the likes of MoneyCube and come in and play a pivotal role. So it's not just a case of saying, well, I'm 35, I'm going to go into a fund today and I'm going to stay there for 30 years until I retire at 65. It's actually looking as you move through your life cycle, I suppose, at where you should be and the funds you should be invested in terms of funds. The second piece to link that, so as you get closer to retirement, you should be looking at, am I in a fund that's too much risk for the age I am, or if it's a fund that is, I suppose, from a funding perspective, too high risk or too low risk based on my age profile. That's the first thing that I would say. The second thing then in terms of pension funds and funding and things like that is, so that links back to the investment return perspective. The second thing then is, when we talk about pension fund crisis, it's really is there going to be enough for people to retire on? So we talk about adequacy. People have enough? And I suppose, really what you're looking at there is when you consider at age 30 or 35 or 40, the fund that you're in, how long you have to save to get to retirement, plus your contributions. So again, if you hit something like 2008, for example, or 2009, when the market kind of decreased significantly, and obviously a lot of people saw a lot of money wiped off their pension. If you were 30 or 35, you had 40 years of age, you had plenty of time to recover. So being in equities or deemed higher risk assets were still fine. If you were age 55 or 60, that's where you had a problem, or that's where you may have had a problem or an issue because you didn't have the same amount of time to recover. So what I would say, I suppose, is critically, and it's most simplistic, is, look at your age, look at the risk of the assets that you're invested in, and do that on an ongoing basis with the likes of a good advisor, such as Ray for the guys at MoneyCube, to make sure that you consistently are invested in a fund to match the amount of time that you have to retirement and the risk profile or the risk that you're willing to take or can take based on the number of years you have to go until retirement.
Okay, very good. Okay, sorry, a question that is popping up here like it's gone out of fashion. What do I do if I've lost a pension, which means you were in a work environment a couple of years ago and you remember that you'd started a pension there, but you might have changed jobs or you've been self-employed, or there's a pension from a few years ago. How do you find that, or where do you go? Is there a pension archive somewhere?
It might be in your sock drawer, right? So I guess what I'd say is, you're right. A lot of people are going to have a lot of different jobs through their career these days, and you're probably picking up little pockets of money each time that you hold down a job for a couple of years. That money hasn't gone away; it's still yours, still got your name on it, but it does need you to maybe get involved with it in and ask a few questions, right? So, one of the questions is around putting all of those in a list. As I say, it might be simple as having that list somewhere and putting it in your sock drawer, but also just being clear in your own mind how it all fits together. It is possible to merge all those into a single fund. There are pluses and minuses to doing that, and that's one of the things we work through with people, whether that's going to benefit them financially, whether it's going to limit their options and that kind of thing. But what's needed is the visibility and the feeling of control over it, and so that means there is a value in at least having a list, and potentially merging some or all of those pensions into a single pot. But I suppose the big message is just because you've got a pension from an old job and you haven't maybe called them up and you've moved house 3 times since you last got a statement, it doesn't mean it doesn't exist. The money is still there and still got your name on it.
Okay, so your piggy bank is out there somewhere. Go find it, basically.
Yeah.
Yeah,
Okay,
and
sorry,
I think if I can add.
Yeah.
No, I was just going to say, just very quickly, just to add to that, from our perspective, in the likes of an insurance company like Aviva, the role that the financial advisor plays in that is absolutely critical. Because again, going back to that thing of just maintaining a list and a record of everything, but also as well, if you have left an employer kind of a number of years ago, again, just making sure, going back to that thing of, am I in the right type of fund or the right type of investment for my age profile? Is absolutely pivotal to kind of just keep a track on that, both from a valuations perspective and also so there's no nasty surprises when you do get closer or at retirement.
Okay, this is a question from me. Obviously, I'm very cynical about pensions. Like, there just seems to be a lot of talk of scams, and I see all these adverts on TV saying, be careful of pension scams. Who do you really know how to trust? It's a big jump, a big leap of faith. How do I know?
Yeah, good question, Liz. And I think
it's
it's really important to cover it off in the year we've had. I think trust your gut when it comes to this stuff. There have been people who've been opportunistic about approaching people through the crisis we've had this year, when people are probably distracted and not in a good frame of mind for making decisions, or in a bit of a vulnerable place at times. So, part of it is trusting your gut. Part of it is, making sure you know who you're dealing with. If something sounds too good to be true, it almost certainly is, and just treading carefully. And also just kind of like this week itself, it's about being aware and using your judgment there. So, yeah, definitely something to be aware of.
Okay. Well, we're coming to the end of our session now. So, Rafe and Stephen, thank you so much for your time and all your intel. I think you've just about managed to convince me to start up a pension, finally. So, I mean, I guess like all of us, the hardest thing is just making the start. But the fact that you've tuned in today and that you've signed up to this webinar is, I guess, the first step in the journey. We're obviously asking everybody to just make a promise to yourselves that you are going to start your pension. It might not be today, it might not be in the next week, but hopefully over the next couple of months, especially when things, we hope, will settle down with the economy and COVID and so forth, that it is on no longer on the long finger, and it's something that they're going to start doing. There's a link at the bottom of the screen here from Pension Awareness Week if you want to click into that, and that we will keep at you. Well, not that we'll keep at you, but the gentlemen and the team behind Pensions Awareness Week will get in touch and hopefully help you on that journey and make things as less complicated as possible, because I think that's what we've discovered today. Everyone finds this whole area extremely, it's bamboozling, but it is something we need to start. And you're kind of giving the money to the government, or you can put it into your pocket. Basically, that's what I'm taking away from today. So we need to start doing that. So thank you all for being involved. And of course, this is Pensions Awareness Week is going on all week. So there's information on the rest of the seminars on the website and also on moneycube.ie. We have all the information too, and feel free to stay in touch with any of the team here today. And thank you for your time. And we hope that we've brought some good insights and information to you today. Thank you.
The team at Pensions Awareness Week Ireland would like to thank you for your participation today.
Whether you're an individual, a company, self-employed or an employee, your financial well-being is in your own hands. With the support of the Pensions Awareness Week team, you can take responsibility and control it. If you want to take action now, you can click on the button below. And we will help you start your journey to build your financial future.